Well, thanks everyone to choosing to spend a little more time with me. I assumed that there'd be some fallout from the last session, but it looks like we have a pretty good crowd. And the title of this talk is "You Get What You Pay For: Timberland Investors' Perspective on Forest Carbon Offsets and Evolving Carbon Markets." I'm going to try to do four things before opening up the session for discussion. First, I'm going to try to respond to the legitimate criticism of forest carbon offsets that have made the news over the past year. Second, I'll provide a framework for thinking about the two bookends of carbon markets: the 100-year compliance carbon market and the 1-year harvest deferral credit market that has more recently developed. These are the two protocols that have had meaningful transaction volume in the US over the last year, so I think they're particularly relevant. Third, I'll use 3 case studies from the Lyme portfolio to discuss an approach to pricing carbon based on the fully loaded cost of encumbering the property and materially reducing harvest levels to accomplish greater carbon sequestration and carbon storage. Finally, I'll wrap up with some conclusions that follow from our observations on carbon markets. Then hopefully we'll have time for a few minutes of discussion. Because my part will take about 25 minutes, I've asked for and been given permission to go 5 to 10 minutes longer, but understand that some folks may need to leave at 3 o'clock or noon Pacific. Before I get started, a little background on the Lyme Timber Company. Our 1.6 million acre portfolio is composed of 7 businesses, all of which include significant naturally regenerated forests. Over 90% of our portfolio is hardwood and mixedwood forests in the eastern US. For this reason, we've been very active in carbon markets. In just the last 18 months, we've sold over $50 million of compliance offsets from 5 different projects on 200,000 acres of our portfolio. And we're now in the process of evaluating carbon on another 1 million acres of our portfolio. As many of you know, despite what appears to be growing interest in forest land investing as a natural climate solution, there have also been criticisms of forest carbon offset markets. People have questioned whether compliance and voluntary transactions have accomplished their purpose to offset carbon dioxide emissions and take carbon dioxide out of the air. The Bloomberg article pointed to the Nature Conservancy's selling of offsets on lands that were unlikely to be harvested. And an honest assessment of many other carbon projects, including some that Lyme has developed, is that while legal and fully compliant with the protocols, they have not required the manager to reduce near-term harvest levels relative to current practice or manage the forest in a manner that is materially different than they would have in the absence of a carbon agreement. A large portion of the carbon sold outside of California has been on tribal lands, NGO lands, or difficult and marginal lands where harvesting well above growth and materially reducing standing carbon stocks was and is simply not possible, and therefore is largely theoretical. In these locations and contexts, it can be argued that carbon markets have paid the landowner to not do what they were not going to do. On the one hand, this is surprising and concerning, but on the other hand, it may simply be an outcome of utilizing a market-based approach to address climate change. In that context, it should come as no surprise that the protocol designs were not perfect and market participants sought out and exploited the inefficiencies that the protocols and markets presented, whether it was selling carbon from a well-stocked property on the border of a supersection with lower stocking, or the above common practice property in Appalachia, where markets and operability constraints would make it nearly impossible to draw down standing timber stocks in any reasonable time frame, or the NGO property that would face donor and community outrage if it were ever subjected to heavy cutting. All that said, I don't think it's correct to conclude that carbon markets are incapable of functioning and delivering climate solutions. The California protocols have gotten tighter, and many of the low-hanging fruit have been picked off. It has become increasingly hard to find projects that will provide large initial issuance credits in the compliance market. And going forward, the opportunities may be more limited to selling annuals where there is a trade-off with timber harvesting cash flows, and the manager does need to change management practices in order to sell carbon. At the same time, it's clear that a segment of buyers in the carbon market, the Microsofts, Salesforces, Googles, Amazons, and Facebooks, are seeking higher quality credits that are truly additional. This combination of factors, tighter protocols, fewer market inefficiencies, and demand for quality credits from aspirational tech and other buyers suggests that there is a path forward for forest carbon markets. Now I'd like to shift to a framework for thinking about enrolling a property in an offset project. I'll start with 100-year compliance carbon, then move to the more recent 1-year harvest deferral credit markets. This waterfall chart is a depiction of the costs and trade-offs associated with enrolling a property in a 100-year compliance project. On the left side, we have a set of compliance-related costs, constraints on forest management, measuring and monitoring costs, foregone land sales, loss of the ability to pursue other options in the future, and impacts on discount rate and exit. The costs represented here are for a hardwood property. Some of the compliance costs under the ARB protocol, for example, the 40-acre clear-cut restriction and restrictions on the use of fertilizers, would present far higher costs on a softwood plantation. And that's why there really haven't been any southern pine carbon projects in the California compliance market. But these constraints are less of an issue on naturally regenerating eastern hardwoods, though they still represent a set of costs to the landowner, which I've estimated at approximately $140 an acre in this hypothetical example. On the right side, we have the theoretical costs associated with drawing down the above common practice inventory to the regional baseline stocking level. We have the significant costs of near-term and longer-term harvest reductions, though some of these costs can be partially offset by product shifts and the potential for higher harvest levels in the future. And the recaptured value is represented by the hashed bar on the right. This brings us to a total cost of about $300 per acre in this hypothetical example, with the costs roughly split between compliance obligations in gray and harvest reductions in blue. The last thing that you'll note on this slide is that the assumed carbon sale proceeds do not fully cover these costs. In this example, they cover only about half of the cost, which begs the question of how timberland managers have been able to sell compliance carbon. The answer is that harvest reductions determined under the protocol are largely theoretical, and on many of the properties, it would be very difficult to materially reduce standing timber to the level of common practice baselines. Thus, the landowner does not incur the full harvest reduction related costs, but does incur the compliance and long-term management costs, which costs are covered by the initial issuance payment. You can argue that this is paying the landowner to not do what they were not going to do, but I think a better analogy is that this is like paying a cover charge to enter a beer hall, then being offered a finely prepared meal, but learning that they've run out of beer. The TIMOs and NGOs who have enrolled properties in compliance projects have not extracted rents from the market. They have delivered carbon dioxide benefits and ensured that the subject forests remain intact for 100 years. But for the most part, they have not had to change near-term management practices to sequester and store more carbon. Harvest reductions determined under the protocol are largely theoretical, and on many properties it would, Okay, so next we'll talk a little bit about the 1-year harvest deferral credits that have recently been a major part of the market. And I'll run through some hypotheticals in a moment. This is an important market that has begun to open up carbon markets to small non-industrial owners of timberland, as well as large industrial owners of plantation lands who have been largely locked out of the California compliance markets because of the forest management requirements under the California protocols. Of course, these markets have their own challenges. The biggest question is whether the algorithms used by NCX are accurately predicting what a landowner or aggregation of landowners would do in the absence of the carbon payments. So let's run through some scenarios. Obviously, getting paid to defer harvest by 1 year is a very good deal if you never plan to perform the harvest in the first place. The arrangement can be a pretty good deal if you plan to harvest and have the ability to fully recapture that harvest plus growth in the following year. The payment is essentially covering the spread between your discount rate as a timberland owner and biological growth. And this works in highly liquid markets where you can time your harvest with confidence. At current pricing levels, the 1-year harvest is not all that good of a deal if it will take more than 1 year to recapture the deferred harvest. This can be the case if the landowner's is supply constrained through supply agreements, contractor availability, and mill capacity. For large industrial landowners, even on southern pine timberlands, it can be difficult to drop the harvest in 1 year and then expect to perform the planned year 2 harvest plus the deferred harvest all in the same year. Finally, deferring a planned harvest can be a bad deal if you will never be able to fully recapture the deferred harvest. This can be the case on hardwood lands and in less liquid markets where a portion of the harvest may become permanently trapped. This brings me to 3 hypothetical case studies from our portfolio. Historically, we've approached carbon the way most landowners have. Carbon developers have come to us with carbon assessments that gave an indication of how many credits a given project could generate. We then considered the obligations that would be imposed on us by the carbon arrangement and made a decision to proceed or not proceed based on the trade-off between the expected carbon payment and the ongoing obligations. In some cases, we've decided to proceed, while in many others, we've decided not to. What we haven't done until now is start with a set of management changes, specifically harvest reductions and rotation extensions, then calculated the price of carbon that would be necessary to induce us to implement these management changes. And that's what we've set out to do here. We did this on 3 properties in our portfolio: our Michigan timberlands, Florida timberlands, and timberlands we own in West Virginia. The Michigan property is fully unencumbered with a long history of timber harvesting and land sales. Our Florida lands are largely subject to conservation easements, and our West Virginia lands are subject to an existing California compliance project. In each case, we assumed 15 to 33% harvest reductions relative to our current harvesting practices. We assumed further that we would maintain stocking levels for 40 plus years. And we calculated carbon offsets based only on the additional carbon storage relative to our planned historic harvest levels. We factored in 48 to 58% leakage and buffer pool rates, and we reduced our land sales in Michigan, where there are currently no conservation restrictions. I'll get to the implied carbon prices in a moment, but I want to first point out 2 key results across all 3 properties. First, our approach to additionality, essentially using our current practice as a baseline. This resulted in less than half of the offsets than could have been realized under either compliance or voluntary protocols. And second, because the quantity of credits was so much lower, and because we needed to fully incorporate the costs of harvest reductions as well as management obligations, the price of our credits was very high and substantially out of market. So let's start with Michigan. On the Michigan lands, you can see a history of harvest levels dating back to 2006, which included the harvesting activity performed by Plum Creek and Weyerhaeuser. And that averaged around 700,000 tons, or 800,000 tons. We've contemplated a 15% harvest reduction, about 110,000 tons per year, and we've foregone the right to drop stocking below its level in any current year, which is to say, standing carbon stocks have to increase over the 40-year timeline. We've also had to eliminate or significantly reduce retail land sales in order to comply with the protocol. Over a 10-year period, this implied a 9% increase in standing inventory. And again, we're contemplating a 40-year commitment. So what does the price of carbon look like in this context? Here you can see that because we have a significant retail land sale program, there was a significant cost associated with eliminating that under a carbon project. That, combined with the loss of optionality and an impact on our discount rate, equated to about $33 a ton just to make those changes. We then layered in the cost of reducing that harvest by 110,000 tons per year, and that added another $36 a ton of cost. We assumed that we could recover some of that cost through product shifts and recapture of the foregone harvest in the out years, but still we landed at a carbon price of approximately $60 a ton, well out of market. Next, in Florida, we assumed a 30% harvest reduction in order to take the lands from current 25-year plantation rotations to 27-year rotations. We also assumed that at no point during the 40-year life of the project could standing timber stocks drop below their current level. And that presented a particularly significant challenge given the uneven age class distribution on this forest. Over a 10-year period, this resulted in a 63% increase in standing carbon stocks. But one interesting dimension here was that over time, as you would expect, we did see a shift in products as we grew longer rotation forests and increased the percentage of saw timber relative to chip and saw and pulpwood. The cost on this property was lower at $50 a ton. And in large part, it was lower because this property is subject to a conservation easement. And consequently, we didn't need to burden the project with some of the long-term costs associated with foregone land sales and impacts on discount rates. So we landed at around $50 a ton in this situation. Next, West Virginia. Here we assumed a 33% harvest reduction relative to what we're currently harvesting at. We're currently harvesting at levels that are below biological growth, and therefore we're accreting volume on this property over time. But what we modeled was a further reduction in harvest by 33% and evaluated only the additionality associated with that additional increase in standing carbon stocks. We had a 5% increase in standing carbon stocks over a 10-year period, and we did assume some product shift to longer-lived products over time. Because this was a compliance project, we assumed a 100-year commitment. As with Florida, we assumed very low costs associated with measurement, monitoring, foregone land sales, and loss of optionality. These were all elements that were paid for in the initial issuance and enrollment of the property in a carbon program. But we did have significant costs associated with foregone cash flows in the near term from harvest reductions. And we only assumed a very modest amount of recapture of those cash flows due to the expectation that taking our property or portions of our property offline would result in further capacity constraints and the inability to ramp the harvest back up materially in the future. So with that, I'd like to summarize what I've presented with some conclusions. First, our assessment is that the carbon markets that we've participated in have largely been ones in which sellers have accepted relatively low prices for carbon in the $6 to $13 per ton range on projects that have sought to maximize offset quantity, but sometimes at the expense of offset quality. Two, right now, some buyers are expressing preferences for quality and also a willingness to pay for it. Three, future projects may generate fewer, higher quality credits or at substantially higher prices. Four, the co-benefits of carbon projects are great, but they add to the price of carbon. We believe that combining carbon projects with traditional conservation strategies can create value both for carbon buyers and for traditional buyers of conservation outcomes. Number 5, something that came up during our discussion earlier, if carbon markets are successful in changing practices, some timber producing regions may benefit while others may face greater challenges. This is a real concern for mills that depend on marginal fiber baskets for their supply. Public policy will need to address the economic challenges that some communities may face as landowners reduce harvest levels in exchange for carbon payments. And lastly, promotion of solid wood for buildings, floors, cabinets, and furniture will help traditional forest products industries compete against carbon. And with that, I am going to stop sharing. So I can now take questions from participants. If you want to ask a question, you'll have to unmute yourself, or you can write it in the chat box. Hi, Phil, do you have a question?
Hey, Jim, I have a question. Can you hear me?
Yep.
One of the things I saw, you had your exit cost, discount rate costs, and one of the things we've been thinking about in the last year is if you take one of these hardwood properties and you've got one of these long-lived projects on it over time, you know, one of the things we're looking at is reversion at some point, but yet you are sequestering carbon in some hypothetical stock of your trees over time, and we're kind of thinking about, you know, yeah, discount or a hit on your gross timber value in some way. Your thoughts on that?
What is the question is, what is the impact on discount rate and reversion?
Well, I guess the question is, what are you guys, how are you looking at that? I mean, what is that discount comprised of, that component comprised of? Is it a discount rate bump on your exit, or is it something else?
Yeah, so I mean, what we would do as we think about an exit from a property is we would be modeling the cash flows well into the future to discount back to a reversion value. And those cash flows would include the out-of-pocket costs associated with measurement and monitoring. So we would have factored that in. And then they would assume the harvest schedule that would be compliant with the carbon protocol. That harvest schedule could accommodate the continued sale of annuals and payments for accumulating more volume, or it could be based on harvesting biological growth and not accumulating additional standing carbon stocks. In general, we would apply a slightly higher discount rate to the reversion cash flows to reflect the fact that there's some loss of optionality on a property that is subject to a long dated carbon encumbrance. Great. So there are some questions coming in. So Brendan Lacey, do you think carbon markets will drive up timber prices as both might be competing for the same resource? Well, it would make sense that if the supply becomes constrained of timber, you could see some increases in timber prices. The real question is, will timber prices, higher log prices to our manufacturing sector make substitutes more attractive and make it more difficult for manufacturers to compete? I think if you take the long view and you assume that over time we'll be imposing carbon taxes on a broad array of products, I think that you can, I would believe that timber will, or wood-based products will compete very well in that context. While carbon may drive up the cost, and in the absence of anything else changing, invite substitution from other products in time. If the full cost of emissions are factored into those substitutes, you would expect timber to compete well. So we do have a quick comment from somebody who works at TNC. I don't know if you want to unmute yourself and.
Yeah, hey, this is Greg Mead. I'm a forester in the Virginia chapter of the Nature Conservancy, and I actually manage 7 forest carbon projects, all on the regulatory market, and have also been involved in sort of some internal analysis that we've done at the Nature Conservancy of our carbon projects. And as you pointed out earlier in your presentation, we were a subject of actually several articles criticizing some of our work. And some of that was probably fair criticism. And we have taken a hard look at what we're doing. And I just wanted to let everybody know that we believe natural climate solutions are still super important, and we're still going to be engaged in this space and can continue to do forest carbon projects into the future. Now, what we have surmised is just what you have found, is that project quality in the past has probably suffered compared to what the true cost of carbon needs to be going forward to generate those high quality offsets. We think there's a gap there, and we're going to do what we can to bridge that gap and get high quality projects, and also the price in the market to support those high quality projects. Interestingly enough, one last comment, we have noticed and participated in RFP processes from purchasers that you've mentioned that do a lot of due diligence and put a lot of emphasis on offset quality. However, they're still they're willing to pay more than the quoted price, but they're still not anywhere near the price that they probably need to be, quite honestly. So I think we still have to have an honest discussion, and maybe the market will bear that out as the protocols improve over time. But anyway, thanks for allowing the comment, and thanks for your presentation today.
No, those are really good comments, Greg, and I appreciate them. And I do think that the volunteer market is a little bit paralyzed right now, because there are buyers out there with an expressed interest in buying very high quality offsets, but they're not convinced that the protocols are delivering that level of quality. So you have, on the one hand, suppliers who are willing to offer up high quality products, and then you have purchasers who are willing to buy them. And everybody's trying to figure out how to make those markets, or not everybody, but there is a need to make some of those markets work. And when they do, when Microsoft or one of these other companies starts to engage in actually transacting in long-term carbon projects that would be subject to their own requirements and at a price point that might be far higher than the existing market, I believe that the protocols will follow. We have protocols to set standards, but if some of these aspirational buyers are setting their own standards as the purchasers, you've got to believe that in time we'll start to see protocols that help to validate and formalize those standards. And that will probably be a good thing if this market's going to withstand the scrutiny of the press and academics and others who I think have raised some legitimate questions about carbon markets over the last 10 or so years. Well, it does not look like there are any other questions. So that means that we have successfully done the presentation in the allotted time. Well, there is one question.
Jim, I do have a question. Can you hear me?
Yep.
So thank you for the presentation. Very interesting. I wanted to go back to slide 14, where you made a statement about one of your results. And I think you said that your additionality requirements resulted in less than half the offsets that could be realized. Could you just explain a little bit how you arrived at that, please?
Yeah, well, so we've done assessments on 2 of the 3 projects as to the number of offsets that would be generated under a voluntary protocol in one case and a compliance protocol in the other case. And because we imposed on our projects this constraint, this requirement that we would only count credits that reflected changes to our current management practices, the credits that we generated and counted in this exercise were fewer than those that would be generated on the protocols. So for example, just to make it a little more concrete, in West Virginia, we can sell annuals on the basis of harvesting if we harvest below biological growth. But because our existing harvest is already below biological growth, we didn't include the portion of the annuals that would flow to us from our existing business as usual practice. We only included those annuals that would come to us from a reduction of our harvest level from its current to something, in that case, 33% below its current level. Does that make sense?
Yes, yeah, it does. It makes sense. I was also wondering whether it was connected to your leakage and buffer assumptions, which seem quite high compared to either the regulatory or voluntary markets. Is that, or are they in line with those?
I think they're in line with those. The voluntary market, it's, I believe, 48% when you combine, at least in our projects, buffer pool and leakage, and the compliance markets around 58%. So we use those.
Okay.
And you know, this was again an exercise to really think about if we wanted to kind of go to the extreme of quality or and in this sense conservatism with respect to crediting, this is what we would do.
Okay. Well, thanks for the clarification and thanks for the presentation.
Yeah, you're welcome. So there's one more question from Mark Berry. You gave a good financial analysis of the harvest deferral. So it's a question about the harvest deferral credits and the NCX markets. And, you know, I think that there is this push to, you know, bring carbon to the smaller landowner. And of course, finding ways to do that more efficiently is important, and remote sensing is an important part of reducing the transaction costs that would otherwise make it impossible for a non-industrial owner to engage in a carbon project. So I think that's helpful. But I do think, and NCX has acknowledged the challenges of adverse selection and the obvious likely outcome that people who are not planning to harvest their forest would take advantage of the carbon payments. And I think the expectation is that if this is scaled up and lots of small landowners are participating, you will actually change behaviors in the aggregate. There will be some of that sort of free rider element, but nonetheless, in the aggregate, you will have accomplished the objective. You know, I think it's a less helpful framework for a large industrial landowner who has who needs to plan harvest levels over a longer time horizon and who can't easily turn the spigot on and off. And for that kind of landowner, I think a longer duration project makes a lot more sense, in part because they can more efficiently deliver a long range project. They are already engaged in longer range planning horizons. And if they reduce their harvest levels next year, they need to think about what the implications will be for the following year and the year beyond that. So for large landowners, I would say, there's less efficiency in just doing a 1-year deferral. And so that would push them towards longer duration. And also the transaction costs on a large land base just aren't that meaningful at the end of the day. What a 200-acre landowner can absorb as far as cost is radically different than what a 200,000-acre landowner can absorb. And so I think the remote sensing is great, and utilizing those tools makes a lot of sense, but I'm not of the belief that those are the critical elements to making projects work on the industrial land base. Great. Any other questions before we sign off? Okay, well, thanks everyone, and I hope you all have a great day, and we'll see you all soon. Thank you.